Hello, friends. If you have your savings sitting in a checking or savings account right now, I need you to stay with me because there is a specific dollar amount that most Americans have no idea about, and keeping more than that in one bank account can quietly cost you in two different ways. One way puts your money at risk if the bank ever fails. The other way puts your name in front of the federal government without you ever doing a single thing wrong. I am not here to scare you. I am here to give you the actual numbers, the ones that come straight from the FDIC, the IRS, and the Treasury Department, so that by the end of this video, you will know exactly how much is safe to keep in one place, what quietly gets reported to the government, and the one common mistake that turns an honest, hardworking person into someone a bank has to flag. Some of this you have probably heard whispered about online and gotten completely wrong. I am going to set the record straight. Before we get into it, if this channel has ever helped you understand your money better, take 1 second right now and subscribe and turn on the bell. The rules around banks, the IRS, and your money shift almost every year, and when they shift, nobody mails you a letter explaining it in plain English. That is what I do here. The folks who are subscribed hear about these changes in time to protect themselves. The ones who are not usually find out the hard way. So hit subscribe, turn on that bell, and let us get into it. Let me start with the single most important number in this entire video, $250,000. That is the amount the FDIC insures in one bank account. The exact rule is $250,000 per depositor per insured bank for each ownership category. Here is why that matters so much. Since the FDIC was created back in 1933, not one single depositor has ever lost a penny of insured money. Not during the Great Depression, not in 2008, not in 223. But that promise only covers you up to that line. If you have $300,000 sitting in one account at one bank and that bank fails, the first $250,000 is protected and the remaining $50,000 becomes something you have to fight to recover, sometimes for years, sometimes at pennies on the dollar. Now, most people hear this and think, my bank is huge, it will never fail. Let me remind you of something. Washington Mutual had over $300 billion in assets when it collapsed in 2008. Size is not protection. The FDIC line is protection. So if you are keeping more than $250,000 in any single bank, that money above the line is not as safe as you think it is. And here is the good news, because there is a simple fix, and it is completely legal. That phrase, each ownership category is your friend. You get a separate $250,000 of coverage for a single account, another for a joint account you share with a spouse, and another for a retirement account like an IRA at that same bank. A married couple using these categories the right way can protect well over $1 million at one single institution. Or you can simply open an account at a second FDIC insured bank and the coverage starts fresh, another full $250,000. You can check your own exact coverage for free using the FDIC calculator called EDI at fdic.gov. It takes about 5 minutes and it tells you precisely how much of your money is actually protected. Now stay with me, because the next thing is the one that trips up more honest seniors than anything else, and it has nothing to do with bank failure. Point 2, the $10,000 rule. Anytime you deposit or withdraw $10,000 or more in cash, your bank is required by federal law to file a report with the government. It is called a currency transaction report, and it has been the law since 1970 under the Bank Secrecy Act. A lot of people panic when they hear this. They think it means they are being investigated or that they did something wrong. That is not what it means. If you sold a car, cashed out a CD, or pulled money for a home repair, and it is honest money, that report is just paperwork. Nobody is coming after you. The report simply exists so the government can trace real criminal activity like money laundering. So do not be afraid to move your own honest money. An honest $10,000 deposit is nothing to lose sleep over. But here is where I need you to pay very close attention, because this next mistake is the one that actually gets good people in trouble. Point 3. Never, ever break up your deposits to stay under that $10,000 line. This is called structuring, and it is a federal crime all by itself, completely separate from anything else. Let me give you a real example of how people fall into it. Say you have $15,000 in cash from selling a truck. You have heard about that $10,000 report and you think, I will just deposit $7,500 today and $7,500 next week, so the bank does not have to file anything. That right there, that decision is illegal. It does not matter that the money is clean. The law specifically makes it a crime to arrange your deposits to dodge the reporting. As one enrolled agent put it, structuring will get you into far hotter water than simply depositing the full amount ever would. The penalties can run into hundreds of thousands of dollars, even prison time. So please, if you have a large amount of honest cash, deposit it all at once and let the bank do its normal paperwork. Trying to be clever is the trap. Being straightforward is the protection. And one more thing on this, banks are also required to file a separate report called a suspicious activity report for unusual activity over $5,000. So those little back and forth games with your account do not hide anything. They only make you look like you are hiding something. Honesty is genuinely the safest path here. Now let me get to the part in the title, the IRS watching in 2026, because there is a lot of nonsense floating around online about this, and I want to separate the real from the fake for you. Point 4. Your interest is already being reported, and you probably never noticed. Here is something most people do not realize. If your bank account earns you more than $10 in interest in a year, your bank sends a form called a 1099 INTI to the IRS with your name on it. $10, that is the threshold, and it has been for years. So if you are keeping a large balance in a savings account that pays you real interest, the IRS already knows about that interest income automatically, whether you report it or not. This is not new, and it is not a reason to panic. It is a reason to make sure that when you file your taxes, the interest on your return matches what your bank already told them. A mismatch is what draws a letter from the IRS. So keep every 1099-E and E your bank sends you and report all of it. Point 5. And this is the one where I get to actually calm your fears, because so many people have this backwards. You have probably heard that starting in 2026, the IRS was going to track every payment over $600 on apps like Venmo, PayPal, and Cash App. A lot of scary videos told seniors that. Here is the truth. That $600 rule was permanently repealed in July of 2025 by a new law. For 2026, those apps only send the IRS a form called a 1099-K if you receive more than $20,000 in payments and more than 200 separate transactions for selling goods or services. And personal money, like your daughter paying you back for groceries or a friend chipping in for a dinner, is never counted at all. So if you were worried that helping family through an app was going to get you a surprise tax bill, you can let that worry go. Just remember, a few states set their own lower thresholds, so if you run a real side business, keep clean records regardless. All right, we are in the home stretch, and this last point ties everything together. Point 6. Do not let large amounts of money sit idle in a plain checking account. This is not about the government at all. It is about you quietly losing money every single month. A big balance sitting in an account earning almost nothing is losing value to rising prices year after year. If you have a comfortable cushion beyond your monthly needs, that money should at least be working for you in an FDIC-insured high-yield savings account or a certificate of deposit where it stays fully protected up to that $250,000 line, but actually earns you real interest. The safety is the same, the growth is not, and here is one final protection that costs you nothing. Ask your bank to let you name beneficiaries on your accounts, sometimes called a payable on death designation, and to set up a trusted contact. Naming beneficiaries can actually increase your FDIC coverage above the base limit at the same bank. And a trusted contact is simply a person the bank can call if they ever notice something strange on your account. That person cannot touch your money or control anything. They are just a safety net, one more set of eyes watching out for you against fraud. So let us bring it all together. Keep no more than $250,000 in one bank under one ownership category and spread the rest to stay fully insured. Do not fear an honest $10,000 deposit, but never break one up to dodge the report, because that itself is the crime. Know that your interest over $10 is already reported, so match it on your taxes. Let go of the false panic about that $600 app rule. because it was repealed, and do not let big money sit idle when it could be safely earning for you instead. None of this requires a lawyer or an accountant to start. It just requires knowing where the lines are, and now you do. Check your own coverage at fdic.gov. And if anything about your personal accounts is unclear, your bank or a trusted advisor can walk you through your specific situation. If this helped clear things up for you, please subscribe and share this with someone you love who keeps their savings in the bank, a parent, a neighbor, a friend. One short conversation could protect them from a very expensive mistake. I will see you in the next one.